Paul Nolte, Senior VP, Portfolio Manager at Kingsview Asset Management. So with the data dump on the way with employment and more, this has got to be important because I think the bond market right now is either doubting Powell's statement of no more cuts or saying the economy is going to weaken or something.
No, it's interesting because when you take a look at what happens around Fed days, this is kind of a normal reaction. Whatever knee-jerk reaction we get on Fed day tends to get reversed the following day. And I think what Chair Powell did was he really set the bar for both sides. When are we going to raise rates? When are we going to cut rates? And I think he made it pretty clear, and I think the markets understand what's happening with that. And then we got thrown a curveball this morning when with trade, that maybe that trade agreement is still further down the road than everybody's anticipating. So again, that's the dynamic, if you will, in the markets today. But I think the Fed's going to be on the sidelines for a while. And I think interest rates kind of hang in here, barring some really extraordinarily weak or strong data points that we'll see over the next few months.
So, Paul, the response today for the stock market is unwinding, but bonds and gold just keep on moving. So to your point about the market now having to prove sort of what comes next, you know, the data having to prove, it seems like we've heard a lot about data dependency for a long time, but it seemed like it was more, you know, bond curve or yield curve dependency or something. So now maybe this is actually the case, and I like your point here. My point would be that the market seems to have made up its mind, though, which is that the data is going to get softer because they're buying the heck out of the 10-year Treasury like there's no tomorrow.
No, absolutely, and I think a lot of that has to do with the trade, the trade information that we got overnight. All right, so here's the deal. When you take a look at a longer term look at the U.S. economy, we're stuck at around 2%. We've been there for 10 years. Inflation, we can't get above 2% and stick for anything more than a couple quarters. And we're not unique to that. It's happening in Europe. It's happening in Japan. So we're going to be stuck, I think, for a very long time in a very low interest rate environment. And where is everybody else? Everybody else is at zero or below. So I think the pull for investors is to buy the highest yielding sovereign debt. We're it as far as the developed markets. So I think that's really, if you look at it from a global perspective, that's where the demand is. I don't think it really has anything to do with the economic data being soft. It's the fact that treasuries are still giving you a pretty good yield compared to everything else that you can buy from a sovereign nation. Okay.
Now, that has been changing a little bit. We've seen some liftoff in the German bond yield. We've seen some liftoff in Japanese bonds as well. But I get the point, Paul, that there hasn't been a big dynamic shift. I want to talk dollar with you, though, because there is some continued softness in the dollar today. On the one hand, you might say, okay, well, the Fed just cut, and economies are pretty slow, and our own economy maybe is slowing, lower dollar. But guess what? We've already had 2 cuts, and it meant higher dollar because basically the exact reason you just told me, because the rest of the world was even worse, and their rates are even lower. So the dollar is like another wrench in this logic.
It is. And, here where we've been talking about for a while, the dollar's been 2 steps higher, 1 step lower, and it's been in a nice upward channel, and it's kind of changed here recently. And I don't know if this is more of a correction of that particular move. I tend to think that it is. Again, going along those the same analogy, the U.S. is one of the stronger economies out there, so the dollar should be stronger overall. And I think that we've gotten a little bit of a corrective move here, certainly with us cutting rates. That helps in the short run. But I think if we go out another month or so, I think we'll see a dollar that's a little bit higher from here, again, because our economy is a little bit stronger than everybody else's.
So, Paul, the last point to put these together, which is the dollar still lower today while bonds and gold are rallying. The trend has been over the last 18 months, or maybe even just make it a year, bonds, gold, dollar moving largely in unison. And the dollar, I think, kind of being the signal of that money making its way to U.S. shores because of the same reasons that keep our rates low, right? So now, is the dollar going to tell us if we have a regime shift? Because to me, it seems like today, let's say this trajectory continues out a week, right? And the dollar keeps dropping while bonds keep rallying. To me, that's going to present a conflict. Will you have to choose which one you listen to gauge the nature of the economy?
over the short run, I would agree with you.
Okay.
However, the economy doesn't move that quickly. So a week, I think, is a little bit on the short side for it. And
Sure,
I would
yeah.
say we're probably still in the knee-jerk reaction port of it. Employment will be kind of interesting tomorrow, but I think once we get past the first of the year, I think it'll be worth visiting to see if this trend persists. So I'm not too concerned about the week-to-week movements. The longer-term trend, zoom out maybe 3 to 6 months or so. And we'll see if those trends persist.
Yeah, all right. Nice job, Paul Nolte, always giving us the straight dope here. Good response. As complicated markets continue to be a little bit perplexing. Paul Nolte, a Senior VP Portfolio Manager. Happy Halloween, Paul. Dig the tie, too. We'll be right back.